Good afternoon, everyone, and welcome to the final session of this Kepler Trust Intelligence event focusing on discounts. We will shortly be hearing from Chris Berrier, the manager of Brown Advisory US Smaller Companies. Chris took over the portfolio on the 1st of April from the previous manager. Since then, NAV returns have been solid versus the index. And perhaps US small caps have been a little bit out of favor, and maybe a bit of a new manager effect has seen the discount widen to almost 10%, which we think could be, potentially a very interesting entry point. Chris takes essentially a quality growth approach, which he will talk a little bit more about later. Before I hand over to him, just a reminder that we will have roughly 30 minutes for the presentation, and then hopefully 15 minutes or so for questions at the end. Please put your questions in the box, which should be on the right of your screen, and I will put those to Chris at the end. I'm afraid you're all on mute, and hopefully we'll try to get through all of them, and if we don't, we promise we'll pass them on to the manager at the end. So with that, I will hand over to Chris.
And thanks, Thomas, for the introduction. Thanks, everyone, for attending today's session. I realize that I might be the only thing between you and potentially happy hour, so we'll try to get through this as quickly as possible, but provide you with a bit of background and an introduction to the strategy. We're going to spend a few minutes first on why allocate to small caps, not to walk through all of the characteristics of the U.S. small cap universe, but to basically put it into some context about what's going on and why our strategy might be positioned well to take advantage of some of the evolution within the U.S. Small cap market. Thomas did indicate that we have been managing this particular trust since the 1st of April. Suffice it to say that this trust was born out of a U.S. small cap effort that dates back to my starting tenure, which is the second quarter of 2006. So we have had, one team, one philosophy, and one process since that time, executing against the U.S. small cap universe with a focus on long-term results. Our goal is to build an all-weather portfolio that is driven by individual bottom-up stock selection and to control risk and hopefully protect to the downside by the quality of the assets that we own, the diversification of the portfolio we construct, and certainly an underlying valuation discipline that goes into what we do. So without further ado, let's go to the next slide. We are fortunate to operate in a very large and deep market, which provides an opportunity for a tremendous amount of optionality and choice. There are roughly 2,000 companies, plus or minus, that we have to choose from. And that's born out of the fact that the U.S. economy has been highly innovative over time, and there's an underlying culture of entrepreneurship. That culture is certainly on display today, where you've seen a number of IPOs that have been created or SPACs that have been created to capitalize on individual company opportunities. And I think that's one of the interesting and dynamic things about being a part of this universe, which is, there is always new and fresh light that's being poured into it. It tends to be episodic over time. We're getting obviously a big thrust of new companies into the landscape today, but it is a large opportunity set that changes out over time. And I think that enables a portfolio manager and a team to hopefully be able to move from one company to another as we progress through each time, to try and make sure that we are providing adequate levels of return relative to the levels of risk that we're going after. The other thing to keep in mind is that unlike some other countries around the world, the hurdle for small cap companies in the US is relatively high. The governance standards are quite strict. If you talk to any private company that is listing to go public, they'll tell you what a significant burden and cost it is to try and get your processes, systems, and reporting up to snuff for the public markets. And so I think that actually provides us with a modicum of risk management, where we feel pretty good that the information we're looking at that's coming out of these companies is fairly accurate and well scrubbed. The other thing that to keep in mind, and this is different from what is typically experienced in Europe, is that while the U.S. market is quite large, it is not just made up of a handful of very, very micro cap companies that are difficult to invest in. In fact, over time, what we've seen is an evolution where the typical small cap company has actually gotten larger, both in market capitalization, revenues, and liquidity profile. And I think that means that not only is the space relatively broad, but it's quite deep and usually fairly liquid. So we have an opportunity to both build and exit positions reasonably well. And so these are some of the high level characteristics that make this market fairly interesting to us. Next slide. This gets into the alpha opportunity, and we won't dwell on this slide because most of you probably have seen similar statistics. But the average number of analysts on the sell side looking at smaller cap companies is dramatically lower than their large cap brethren. When you think about a company like Google or Microsoft, there might be 30 or 40 or 50 analysts covering the business. It's extremely difficult for a buy side group in order to be able to overall exact some sort of angle of attack or to create some sort of informational or analytical inefficiency so that you can generate excess returns without necessarily taking on excess risk. I think in the small cap space, that is present. We do have an ability, I think, with a well-organized and appropriately deployed team to go out there and find an angle of attack that we can monetize on behalf of our investors over time. And so while this universe is not wholly undiscovered, there certainly are people covering these companies. I do think we can bring a level of rigor and depth to our due diligence process that hopefully can add value and certainly generate some alpha over time, which is our goal on a bottom-up basis. Next slide. So this is another interesting chart that is worth talking about, which is if you go back looking at long history, one of the interesting parts about the smaller cap space is, yes, it is more volatile on a day-to-day basis than large caps. So in essence, are you getting anything for that excess volatility? And the answer through time is seemingly yes. The returns over rolling periods of time, or when you look over very, very long periods of time, tends to be better than the mid cap and large cap space. And again, I think most of that is coming out of the aspect that these companies are somewhat undiscovered, they're less well researched, and we as a group are trying to find that small cap company that hopefully one day is adequately discovered and becomes a mid cap or large cap company over time, and then basically rinse and repeat, dive down the market cap spectrum and benefit as the companies get larger. Next slide. There's also some interesting things that have happened since we've experienced the pandemic or transpired really in the last couple of years. What is historically true about the small cap space is it tends to do well after periods of economic distress or market dislocation. And we've certainly seen that over the last couple of years here. And we've seen it in spades over a short period of time. And one of the tendencies that we've seen at early in market recoveries is that the riskiest of the risky tend to do well in the initial stages of an economic and market recovery, but then the baton is fundamentally passed to higher quality issues that might be on offer in our space. And that was certainly the case coming out of the pandemic, where not only last year, but certainly in the fourth quarter of last year, we saw a pronounced move in penny stocks, companies with low share prices, unprofitable businesses, highly shorted companies, high beta businesses. All of these things did extremely well coming out of COVID. And I think the opportunity that sits in front of us is that there is likely to be a pivot back to some of the more quality businesses that we tend to be focused on as this recovery matures over the next 6, 12, and hopefully longer period of time. Next slide. To put this on display even more prominently, as you can see, one of the good proxies for quality and lower quality, and this is not to say that companies that don't make money are all low quality. They're certainly not, and we actually are invested in a few that don't make any money. But you can see the pronounced outperformance of companies that don't make any money in 2020 relative to those that do. You know, it's nearly a 45 percentage point delta between the earners and the non-earners. And once again, that began to rear its head early in the stages of 2021, but we've since seen some reversion back to where quality has started to outperform a little bit more. One of the factors you can see that's at play in our universe, and this has been a change over the last several years, particularly with the onslaught of new issuances that have occurred, is that the number of companies that make no money in our respective area of the market, here measured by the Russell 2000 growth, but you can also see a similar phenomenon in the Russell 2000, is that the number of loss makers is pushing up towards half of the overall universe. This is up about 20 percentage points from what we've seen over a long period of history, and also is probably a phenomenon that will correct itself over time as once again the pendulum tends to swing back from lower quality issues to higher quality issues. And also what you tend to see is over time a divergence in performance with quality outperforming long term. Thus you see them gaining weight in the overall benchmark, and you tend to see the lower quality companies shrinking in importance in the benchmark as well. Next slide. Here you can tend to see where some of these non-earners are coming from. And as you likely would have guessed, the pronounced majority of it sits in healthcare and technology, which is where a lot of these earlier stage companies are getting ample funding despite some of their losses because of tremendous levels of growth that have been attained, and certainly tremendous amounts of liquidity and capital markets formation over the last several years. So we've seen a movement, particularly in healthcare, toward it carrying a larger and larger proportion of the weight. And we certainly have seen, as these companies have done well and received more capital, thus translating into significant IPO and SPAC activity of late. You can see that we've reached new all-time highs in 2020. Some of that is spilled over into 2021. And it's been a prodigious period of underlying new issuance, which is great from our point of view because it gives us a lot of new companies to look at, which is a net benefit. But you also have to make sure that you're careful in a period of time where you see tremendous new issuance, because it tends to be a period that is heightened with, lesser risk aversion in the market and perhaps greater risk taking, and therefore maybe some lower quality businesses are getting funded and getting public, and you need to have a appropriate team that's going through these things with a fine-tooth comb in order to sort through what's good and what's not so good in terms of the new issuances being created today. Next slide. One of the other interesting things that we think could create some compelling arbitrage opportunities or inefficiencies over time is simply the amount of passive capital that's been allocated to small caps over the last several years. It's grown from about 10% or so of the overall small cap market about 20 years ago to nearly 50% of the small cap market today. While we can't form any general conclusions yet about how this might impact asset prices on a go-forward basis the next 3 to 5 years, we can certainly say that what we've seen is that flows have become a greater dictator of corporate stock prices than they have in the past within the small cap space. There is a seemingly tight correlation between flows coming into small caps, the more illiquid stocks outperforming and having their valuations soar, and when flows go out, similar but opposite phenomenon happen where the illiquid stocks are hurt the most during more challenging periods of time. We think that this will provide, monetizable opportunities for us to hopefully sell some of our holdings at very, very attractive prices as flows come in, and certainly hopefully pick up some interesting assets at relatively cheap prices as flows perhaps go in the opposite direction. So I think there's episodic opportunity here And we also think that over the long term, it's important for us as managers to be well apprised of, what is taking place with each of our individual holdings, where they held, what indices, what ETFs, so we can make sure that we're on top of price movements to separate out, signal versus noise overall. Next slide. So this is a summary statement really of what has been occurring in the small cap market. As you can see, high quality has been taking a drubbing relative to lower quality recently, with some hope in the very, very short term. But this has also been true over a longer period of time, where we've seen, high quality and low quality based upon various measurements come in and out of favor. And thus we feel like, as a strategy, in fact, that we've been swimming a bit upstream over the last few years. It's been a market where valuations have soared, momentum has been prized, lower quality non-earners have prospered, and I think some of the typical quality companies have been left behind. And we think that there is an opportunity to perhaps monetize some of those changes in regime as we move forward here the next 2 or 3 years. So if we go to the next slide, just a quick summary. We think that we've got a broad and liquid space to take advantage of. We think that still, despite the growth in financial information, there's an opportunity to do rigorous deep due diligence on these smaller cap companies to your advantage, both informational and analytical opportunities to uncover and build a richer mosaic of the companies that we're looking at. We think that over time that some of these dislocations will start to move the other way, hopefully becoming a tailwind versus a headwind for both absolute and relative performance. And we think that now is a reasonably good time to have an active manager, whether us or somebody else, frankly, that is really focused on bottom-up stock selection and is super focused on the quality and price of the assets that they're buying into a particular strategy, with an eye, under a regime of higher valuations, toward not only managing upside potential, but managing downside risk as well. So that's a good bit of an overview on the small cap space. And now let us turn to some of our philosophy and process so that you can get a better feel about who we are and how we attack the market. So let's start on the next slide with team. When we think about our team, this is the foundation of everything that we do. It is the people that I work with day in and day out that are driving the underlying performance of this strategy. We need to have the right people in the right seats. We need to have them incented appropriately. And we need to have a culture of collaboration and teamwork that takes all of our disparate viewpoints and tries to come up with the best solution on behalf of our clients. It's a privilege for me to get to work with all of these individuals day in and day out. I'm fortunate to have George Sakalaris work alongside me, who has a very, very long history within the small and mid cap space as well. And this is a collaborative activity. And the final thing I'll say is that overall, our firm is an investment partnership. We have 100% of our employees owning equity of some sort in our firm. Our firm overall is 70% plus owned by its employees. And for many of us, our ownership in the firm and our underlying investments in the strategies that we manage are our largest financial assets. So we feel as though, based upon the ownership structure of our firm, the incentive system and compensation methodology that we've laid out, and the team structure that we've developed, that all of those things are rowing in the right direction, and that they are all very much aligned with our underlying shareholders. If we as a firm don't do well by our clients, our equity value is not going to do very well, and therefore we're going to be harming ourselves. We think the firm has done a very good job, A, of assembling a structure that matters, and B, assembling a team that hopefully can do a good job of ferreting out the good from the bad within the underlying small cap space. Next slide. Our investment philosophy is meant to be extraordinarily simple. It sits on top of our team, and it acts as a guidepost for how we are conducting ourselves day in and day out. This investment philosophy is born out of two facts. One is that when you look at a lot of portfolios, whether they're venture, private equity, or public market, you'll see that typically it's a handful of great businesses attacking ample end markets that drive results or alpha year in and year out. So by definition, those are the types of businesses that you want to try and skew your portfolio toward. Who are the horses that you think you can ride year in and year out and are going to be consistent outperformers? The second piece of our investment philosophy is that active managers functionally have two cardinal sins. One, we sell our losers too slow, which we do our best to guard against. And two, you don't hold on to your winners long enough. So this investment philosophy of trying to harness the power of compounding to drive attractive risk-adjusted returns over time and through a full market cycle really anchors us in what is important. We need to find the businesses that have the capability of compounding and moving from small to mid to large over a long period of time. And we have to make sure that when we find these winners, we hold on to them, but with prudence so that they can maximize their benefit on behalf of our clients. So we take a long-term approach in a short-term world. It's born out of a lot of empirical evidence and data that we've ingested and read about, and it's one that's been in place the last 15 years, and we believe continues to serve us well today and probably will so in the future. Next slide. So with that philosophy statement, it really begs the question of, if you're trying to find these long-term compounders, what do you look for? Where do you go? And a number of years ago, we did some case studies on businesses that go from small to mid to large, and we looked for commonalities, both in the management teams, their business models, the end markets they were attacking, et cetera. And then we tried to simplify some of those commonalities into a very catchy investment filter. And we came up with the 3 Gs. And this is our checklist for long-term compounders. So we're looking for durable growth, sound governance, and scalable go-to-market strategies. I'll touch on a couple pieces of each and then push the next slide. First, on growth. We're not looking for nosebleed levels of growth that are fleeting. We're looking for durable growth, companies that can compound year after year after year. That means we've got to find large addressable markets relative to the revenue base of a company. And we've got to make sure that those businesses are doing something differentiated. Is there a product, service, business model? Is it a company culture? What separates them from the pack? Because that enables you, if you're attacking a large and growing market, capture a larger and larger slice of that growing pie over time. And that allows for a long runway, and that allows for durable growth and long-term compounding. So the end market opportunity compared to the company is paramount in where we start. The next element is governance or people. It's great if you have this wonderful opportunity, but if you don't have the right people in the right seats with the right plan in place and the right type of incentives, you're likely to fall way short of achieving your potential. So we spend a lot of time up front looking at the governance architecture of a company. We're looking at the board structure. We're looking at the incentives laid down from the board. We're looking at share ownership. And we're trying to make sure, very simplistically, that we trust the management team. We believe they're transparent in their actions. And we believe that longer term, they're aligned with us, which is maximizing long-term shareholder value, not necessarily earnings for the next month or the next quarter. The final piece of the puzzle is, if you can find a great team attracting an attractive end market, it's great that you have high levels of top line growth, but at some point in the future, hopefully in the foreseeable future, that strong top line growth has got to translate down into solid levels of profitability, free cash flow generation, and good returns on invested capital. And the way we try to think about how our businesses scale and how that revenue growth would be translated into those factors is through the go-to-market motion of a business. How do they package and price a product or service? How do they distribute that? Is it direct? Is it indirect? Is it through sort of value-added resellers or technology partners over time? And we try and think about, of the incremental dollar of revenue that's coming into the company, how does that flow to the bottom line? What's the incremental margin? What are the returns associated with it? How capital intensive is it? And so what we end up with are these three areas that we should be concerned with. And if we can find a company that possesses and gets relatively high marks in each of these areas, the chances are it has a higher probability of making the journey from small to mid to large and becoming a long-term compounder. So these are the characteristics that we care about when we look at a company. Next slide. So this is a quick overview of our investment process. And if we had a full hour or 2 hours, we'd probably could get into the details. But I'll try to just go through and tell you, what matters, and perhaps at the end of the day, where do we differ from some of our peers? So once again, we've tried to bucket this into three simple facets of the process. One is idea generation, two, due diligence, and three, portfolio construction. So on idea generation, we already mentioned that we've got a large universe. It's a couple thousand companies. And the goal for us is, how do you sort through that in an intelligent way to come up with a targeted list of businesses? Now, we've been fortunate to be doing this 15 years. So we have a relatively strong working knowledge of the universe that we're attacking. We also have a rigorous monthly methodology of breaking that universe down and assigning orders, rank orders of what an analyst should be focused on each month, so that we end up hopefully attacking and triaging that area of the market the best. But what are we focused on? How do we find these companies? How do we apply the 3G filter? The reality is, we don't use a screening tool that tells us certain factors exist in these companies and that's where you go. And while quantitative screens are useful, where they fall short is they tell you virtually everything that's happened in the past, but nothing about what's going to happen in the future. And stock price movement is all about change at the margin. And what we want to source is positive change. So we are interviewing hundreds of management teams every single year. We're applying our 3G characteristics in our conversations with those management teams. And we're trying to figure out, is there anything going on internal within the business or in the ecosystem that surrounds the business that's going to make life a little bit easier for them in the future than it has been in the past, such that revenues inflect up, margins inflect up, free cash flow is better. What's our angle of attack? We get through to that with a labor-intensive interview process of literally going through hundreds of companies a year. And as we ferret through these companies, we end up with a large library of knowledge around our investable universe that certainly has existed over the last several years, but grows every single day that we come into the office. So that's the idea generation. Our goal is to stuff as much into the top of the funnel as possible, and then apply our 3G filter to see what goes through into the next step, which is due diligence. Now, we are a bottom-up oriented investment process. We try to make sure that our bottom-up investments don't have any unintended top-down consequences. But we, in our due diligence, probably don't differ so much from some of the bottom-up investment managers that you all have spoken to over time. So what are we focused on in our due diligence? The reality is that we believe in the 80-20 rule. We think 20% of the things that you look at for a company are going to drive about 80% of the value. So we're trying to isolate the 2 or 3 core value drivers that we think you have to get right to make money. We then go out and put a plan together to do some primary due diligence, hopefully through our own Brown Advisory Investment Network, talking to private companies to the best of our ability, leveraging expert networks, talking to customers to see if we can't collect enough evidence so that against these 2 to 3 value drivers, we have a differentiated viewpoint. If we think we have a differentiated viewpoint, we start to look and see what metrics that emanate out of this business can we attach to the underlying value drivers. We then look at those metrics historically and we try to model them out prospectively to see, do we think these things are going to trend in a more positive or perhaps less positive direction than what's embedded in the current stock price? And certainly where we think the company meets the characteristics we're looking for, has value drivers that seem to be teed up to move in a better direction than the consensus believes. And we think the stock is trading at a price that allows us to get in with excess upside without a commensurate amount of downside. That's an interesting opportunity for us to take advantage of. The final piece of the process, which is most self-evident, is portfolio construction. We have a high active share portfolio because that is the right path to go down if you want to outperform. What is required when you have high active share is very strong execution and consistency in that execution. Because while high active share portfolios are the ones that both outperform, they also can be the ones that underperform by the most. And so as we take a relatively concentrated approach that drives this high active share, we know that there's an increased burden on us because of that concentration to be holistically diversified and to have robust controls over the portfolio, both at the company, sector, and portfolio level, to make sure that we don't get over our skis in any type of a factor related to the portfolio and how it's managed. So what we're attempting to do with the portfolio is to essentially build something that one can own through a full market cycle, benefit from solid stock selection to drive returns, and then hopefully see their risk mitigated by the fact that we tend to own high quality assets, we tend to be diversified appropriately, and we tend to certainly have an element of valuation discipline in what we do. Next slide. This is a quick snapshot of some of the characteristics and how the portfolio is managed. Again, high active share in the low to mid 90s. We manage our position weightings a max of 5%. Our minimum position size is about 0.5%. Anything below that is working its way up and into the portfolio or out. We try to conviction weight the portfolio based on upside and, importantly, downside. You know, typically the names that we see at the top of the portfolio, both are contained on the downside and we think have ample upside risk. The positions that are maybe smaller in the portfolio perhaps have more upside, but also carry with them, you know, shorter or higher, shorter term risk or higher near term volatility than maybe some of the names at the top. You know, we diversify in a variety of different ways, which we could get into if we have more time. And there is a consistent, based upon this 3G filter that we use, a consistent quality bias that, again, I think has been, in fact, maybe a bit of a headwind to us the last several years. But we believe hopefully will shift to being more neutral and perhaps even a tailwind as we move forward over the next year or two based upon what's transpired in the market recently. So our investment philosophy sort of drives what we buy and how long we own it and the factors that are important to us. But sort of begs the question on the opposite end of the spectrum, why do you sell? And the three opportunities in the orange bars here are the three reasons that we sell. But I would tell you that we spend the vast majority of our time on our thesis being violated. As I mentioned prior, we focus on these key metrics. We focus on how those metrics are trending relative to our investment thesis every single quarter or new information comes out. And it's this wiggle in the key metrics that hopefully provides an early warning signal as to whether we should begin to lower or perhaps eliminate a position. One thing that we've done over time is looked at all of our trades, both buys and sells, to see if there's any tendencies or biases within the way we manage. And I think one of the things we've become better at longer term is being a little bit more aggressive at scaling up our buys initially, because that's something that from the data we realized would drive greater value. And the other thing is we tended to have a reasonably good gut selling. And the data told us we should be more aggressive in our sales. And so we tried to do and embrace that over time. And I think hopefully that speaks to, you know, a culture of continuous improvement and learning. You know, we need to get better every single day because we operate in a very competitive field in terms of public asset management. Next slide. This is just the small cap universe overall based upon the Russell 2000 index and the Russell 2000 growth. index. This is meant to give you just a quick snapshot of how these two indices are oriented. The next slide, 19, highlights how we are positioned compared to the index overall. As you can see, we have a reasonable weight in healthcare and technology, although if you double clicked on our exposures compared to that of the benchmark, you would probably see far fewer money losing companies, and you'd also see much tamer valuations in our architecture compared to the benchmark. And if you looked at our exposures relative to the benchmarks overall, you'd also see that we tend to shy away from commodity-oriented businesses, and that means our exposure in certain other areas of the market, like materials or like energy, like utilities, tends to be a bit lower than the overall benchmarks as stated. The next slide is meant to give you just a quick snapshot of our top 10. Over the long term, we've had about 30% of our weighting of the portfolio in the top 10. Many of you may know a few of these companies, but suffice it to say, you probably know less of them than you do know any of these. And so what we've attempted to do is balance offense versus defense in the top 10, new, younger, innovative, perhaps faster growth with some more mature companies that we might have owned for top 5 or 10 years. And that provides a nice barbell and balance in the portfolio, which is emblematic in the top 10, but also exists throughout the portfolio as well. If we flip to the next slide, we'll just touch upon the attributes. I think one of the things that is misleading about the indices that we look at or the portfolio is when you roll up some of the company characteristics, they're not all that meaningful to both absolute and relative results. We've seen these vary, both the index and ours, over time, and we don't see a very high correlation between the averages that we see and the performance or downside capture of the strategy. I think the most important thing to remember is that typically we have a lot fewer money losers in the portfolio, and we tend to have a much more mundane valuation or reasonable valuation than the benchmarks that we're compared against. So in the last slide or two here, let me say, if you just forward again, we just took over the management of this. We underwrite our companies for 2 to 3 year views. So short-term results aren't necessarily indicative of how things will play out longer term. But we're pleased that we were able to do a smooth transition of the strategy from the prior managers to us. We believe we touch base with many of the shareholders of the strategy who know and understand how we're conducting our affairs. And we're off to a reasonably good start. And hopefully, fingers crossed, we'll be able to keep that up. And if you flip to the next slide, you can see that, over time, here are some of our, shorter term and longer term results of the strategy. And as I mentioned before, our goal is over a full market cycle measured by 5 or 10 years to generate 100, 200 basis points, hopefully more alpha. And in other words, generate excess returns while taking on a lower level of risk than the benchmarks. I think the data overall has certainly borne that we've accomplished that goal over time. And our drive here is to make sure that the team, the philosophy, and the process remain intact so that we can continue to do so in the future. So with that, I'll forward and have one more slide just for some high-level information on the strategy and open it up to any questions in the remaining 5 to 10 minutes of time.
Brilliant. Thanks very much, Chris. We've had quite a few questions come in, but if you're listening, please do keep your questions coming. We'll try and get through all of them. So someone has flagged that you have, of course, the open-ended fund available, the OIC in the UK market too, which on a very similar strategy. Could you explain what the difference is between that portfolio and the portfolio you run for the investment trust? And it's been flagged that over the last 6 months, the open-ended fund has slightly outperformed. Could you explain why that is?
Yeah, I think the underlying difference in the performance would just be a small handful of holdings and perhaps cash moving around. So that would be the primary delta in terms of underlying performance. in the short run. The other way that over the long term you'll see these strategies differ, although quite similarly currently, as we wanted to get off to a start that was solid, that embedded everything that we know and understand about our companies and the universe that we're going to be compared against. We do know that the typical structure here allows for some differences over time, whether it be differences in weights of some of the underlying securities because of the unique nature of the trust, or the underlying ability to use gearing. And so while we think the use of leverage will be episodic in nature and not something that we have deployed today, we do believe that over the long term, there will be some divergence between this particular structure and the underlying funds that we have managed over the last 15 years. And that would be the resultant use of a little bit of gearing, along with perhaps some higher concentration in a few names that exist in the portfolio overall. So it won't be a dramatic departure, but I do think at the margin, there will be some more variance in the returns between the underlying strategy and this particular vehicle as we move out in time. Again, it's only been a few months. We wanted to get off on a good footing. We wanted to start wide and narrow as we go based upon how the market afforded us some opportunities. And so you'll probably see the variance increase a little bit over the next coming quarters.
Thanks. And you mentioned, the ideal scenario being where you can buy into a company when it's very small and watch it grow into the mid cap space. Are you forced sellers when they get outside of your index, or can you hold on? Do you have some freedom of movement there? How do you deal with that when your successes?
Yeah, we have tried our very, very best to provide a framework for our clients in terms of rules and guidelines that we were going to abide by. But we tried to also make sure that embedded within that, we had as much flexibility as humanly possible. And one of the areas of flexibility is that while we have told all of our clients that we are going to manage the overall strategy to stay within the small cap sandbox, we were not going to micromanage individual positions. And so it is the case that we have had companies that had started at $1 billion that are 15 to 20 billion in size in the portfolio today. Now, when we get to those levels of market capitalizations and tenure in the portfolio, 5, 7, 10 years, is it the case that we look at those as opportunities, if appropriate, to recycle capital out of those and deploy it into earlier stage opportunities? Yes, absolutely. We're always trying to balance, earlier stage businesses, maybe maturing businesses, and then somewhat legacy positions, and get that mix in the portfolio right. And we're trying to recycle the capital in a virtuous manner where, as we feel the law of large numbers or the weight of the market cap is too much, we're going to move capital out of those, eliminate them, and recycle them in. But we don't have any artificial cutoffs in terms of market cap, tenure in the portfolio, or restrictions of not being able to own securities that are outside of the Russell 2 or the Russell 2000 Growth Index.
A question about concentration. So 80 holdings, roughly 70 odd holdings, I think, on your presentation. Do you think that is concentrated, or do you think one could argue maybe that's very diversified? How do you think about concentration, and what is the sweet spot for you?
Yeah, I think the reason that we use the term relatively concentrated and not in fact concentrated is to make the distinction that's articulated in that question. When I first started managing this strategy, when we took it over from the legacy managers, they had 32 names within the strategy. And the only issue with that is you tended to have some pretty high skews in terms of your overall allocations within the portfolio. And you had a difficult time, given the numerous businesses and the uniqueness of the companies in the U.S. small cap space, of getting balance across different sectors and subsectors. So our belief was, and there's no magic to this number, that within the small cap space, a higher number than 30 or 40 is necessary to give you adequate diversification. I think 30 to 40 in the large cap space um, makes sense. And that's what all of our large cap funds at Brown Advisor essentially have, about 30 to 40 holdings. So when you look at us, 60 to 80, it feels about right. There's no magic in that number. Most of the funds on offer here domestically or internationally have not double the amount, but are up in the 120 to 140 range. So I think you take the high end of that range, we're about half the number. If you take the low end of that range, we might be about 70% of the number. So I think that's why we use the term relatively concentrated. The final thing I'll say is a friend of mine who happens to be a small cap strategist did a long-term study on small cap portfolio performance. And what was interesting in his results is that the number of names, the sweet spot for alpha was somewhere between 80 to 120 as a group. Now there were outliers there, being a little bit more concentrated or less that did well, but for some reason, sort of that order of magnitude was about right. For us, the reason we're a little below that 80 number is that, well, we tend to have a few names that have matured over time, represent relatively stable companies, maybe much more stable than the typical small. So I think we can get away with owning a few less than maybe what would be indicated by his study. And the study is not meant to be some sort of gospel, but it's at least an interesting data point as to where successful managers in the space have gravitated to over time. And we think somewhere at the lower end of that range is probably the right place to be.
Now, a couple of questions here on more macroeconomic matters that I might sort of place together. So, firstly, in terms of the economic cycle, where do you think we are, and what do you think that means for your portfolio? I suppose one of the key factors to consider is rising interest rates. Which, we're expectations are coming forward of interest rate rises. People are worried about what that would do to large cap growth stocks. Would your universe be affected too? And then in terms of the infrastructure plan of the current government, have you found any opportunities there, and are there opportunities in the stimulus packages currently going through Congress?
Yeah, I think the conversation around COVID, the economic cycle, interest rates, Fed activity is a extremely important and interesting conversation that could last several hours. So if I boil it down as much as I can, my observations within the small cap space are that, yes, to the extent that you own a lot of long duration holdings, those being where the earnings are way out in the future, and they benefited from having extraordinarily low discount rates over time. Those businesses would predominantly lie in healthcare and technology would be as vulnerable or more vulnerable than some of the large cap growth stocks to appreciable rises in interest rates. So we tried to do our best here of peeling back, our weighting in some of the companies that we think are vulnerable. And so what is clear in a rising rate environment is what you would like to omit or minimize in your portfolio. What becomes a little bit more challenging is, what type of active commission in terms of what do you want to own in your portfolio to benefit from rising rates. And so you can buy banks, you can buy some commodity companies, things that might have, more acute rises due to inflation accelerating. But we need to do that in a way that doesn't compromise the philosophy and company characteristics that we discuss. So we're not going to go out and buy an E&P company just because we think energy is the most sensitive area to inflation accelerating. We're not going to go out and buy 5 banks just because we think if rates go up, their spread business is better, those stocks are going to do well. But we will attack each of those areas and try to figure out, can we both find businesses that have certain characteristics that we look for and have a way that as a hedge against rising rates. And I would say that over the last couple of quarters, there's been a handful of businesses that we've upsized in that vein, or we've bought into the strategy in that vein. But I think most importantly is we've tried to the best of our ability to make sure that we're not over our skis in long duration assets at a time when perhaps rates and inflation have nowhere to go but up. So that's sort of the first component. I think the other piece of this is, where are we in the cycle? It's hard to know given what happened with COVID. There's too many cross currents to really feel it. I think at the end of the day, our internal view, or at least my view, which by the way doesn't play a tremendous role in the strategy, because I don't think my top-down insights are any better than anybody else's. But I think what is the case is that we've opened up, we're trying to recover from COVID, lots of stimulus and liquidity is in place. That's helped the economy accelerate. We'll at some point work through all of these tremendous supply chain bottlenecks that you're seeing today. But I think what's going to accompany that is a normalization of growth. So it is my opinion that what's happening is we have prodigious growth today. That growth will tail off a bit, the pacing of which is somewhat going to be dependent upon, what type of economic infrastructure package comes out and where the money is spent. If the money is spent on human capital and infrastructure for the most part, probably doesn't have a big benefit or as big of a benefit to a lot of the industrial companies. If it is more bricks and shovels and projects, I think that then you set up a more constructive backdrop for the industrial companies, which also might benefit from some inflation through time. At least they have historically. And so that's why when you look at our portfolio, we've been adding selectively to industrials. Our weight is probably about in line with the benchmark. We probably have a little bit less cyclicality, but we're still looking and hunting for opportunities that perhaps might benefit from a more conducive environment in the future due to infrastructure, et cetera, than in the past. So that's kind of our base view. But again, we try not to weigh our top-down views too heavily in how we conduct our bottom-up affairs. It's really just to make sure that we're not committing any unintended top-down consequences from our bottom-up bets.
So looking at a sort of stock-specific level, if we look at, say, Workiva, your top holding, which quick Google tells me is possibly up as much as 50% year to date. So this is in the technology space. Could you tell us a bit about, the attractions of this stock? And I suppose the comparison for the UK investor would be, well, should I own Alphabet or should I own small cap tech? And I suppose the Googles of this world are probably much more exposed to the macro environment than something like Workiva. Is that fair?
Yeah, I think that is a fair general comment. Using Workiva versus a Google, it probably depends on the comparison. But if you took the class of companies like Workiva and the class of companies like Google, these sort of large, systemically important technology companies that everyone on planet Earth owns, then yes, I would say you're probably over time going to be better off owning things that are under the radar and have their own opportunities that aren't quite as picked over as perhaps the Googles and the Microsofts of the world. Those are great companies. They're clearly dominant in their respective areas of the market. But I think there is a better opportunity in names like a Workiva. I think what's important about, the position in Workiva is that it's largely gotten to where it is on merit. It has appreciated quite dramatically. We've actually peeled back a little bit of our weighting here in respect of the recent rise that it's had. And Workiva started out as a software package to present your SEC filing. It simplified it, automated it. And several years ago, they realized that this platform for presentation that they had could be more broadly applied. Investors soak up presentations, finance committees soak up presentations, boards soak up presentations, governing bodies soak up presentations. So they re-architected the platform, modernized it, and then added a tremendous amount more functionality. And now they're in the process of selling that software suite to a number of large public companies who want to automate the function of creating presentations similar to this one. It takes system of record data, ties it into their software suite, and automatically updates the output of all these presentations that a company might have in order to simplify it and hopefully create a more robust security and accuracy environment for the presentations overall. When we bought the stock, it was trading at a mid-single digit multiple of sales. And for the first year and a half of our ownership, we watched the stock bounce around despite watching the company make good progress, not only on the product itself and the platform, but also in its go-to-market activities. So the software market expanded dramatically, which provided a pretty big halo valuation for it to expand up and into. And we thought the fundamentals were playing out. We also knew that from going to their user events, that there weren't a lot of buy-side people paying attention to this company. And so lo and behold, the thesis began to play out. I think at the margin, COVID helped them a little bit as people are remotely working and have to assemble these presentations. They're looking for tools. I wouldn't really say it was a net COVID beneficiary because they did have some go-to-market disruptions along the way that hurt growth for a quarter or two. But now on the backside of that, they have an ESG reporting product. They have a product that is related to a number of the ESEF mandates that are going on in Europe for financial reporting and tagging. And I think some of these regulatory initiatives fit very, very squarely in front of Workiva's software platform. So our confidence that the revenue growth, which was solid, will accelerate and stay high for a longer period of time than many might think is pretty high. What tempers our excitement today and why we've trimmed a little bit of the position is that, you know, the multiple has gone from mid-single digits to high single digits, low double digits, still below the SaaS universe overall. But we want to be respectful that if the regime changes, if longer duration assets, technology companies come under pressure, so we enter a different environment, we just want to make sure that, you know, our largest holding isn't overexposed to that type of development. But that's why we're also buttressed by the Genpacts, Waste Connections of the world, BFAMs in our portfolio that perhaps represent an opposite type of position to what Workiva represents sitting at the top of the portfolio. So sorry that was a little long-winded, but it's a good example of us trying to find something that we think will be valued more dearly in the future than it is today.
No, not at all. That was very interesting. Thanks. And thank you very much, Chris, again for the presentation. I think we've just about got through all the questions and we're coming up to 5 o'clock, so we really should bring it to a close. So thank you to the audience for your attention this afternoon and for the whole day. I hope it was useful. And thanks once again to Chris. Very good to hear from you again. And hope we'll hear you all at our future events. So have a good evening.
Cheers. Thank you all.
Bye-bye.